Right, everybody, I don't really need to introduce them, do I? We've got Zee. This is going to be a bit of an interactive session, so hopefully everyone can sort of get on board and ask questions and things like that. Anyway, over to Zee.
I'll let Ishtiaq sit down. This is a bit loud, isn't it? Is everybody?
Good.
Right, so we're going to blast through this because we only got about 30 minutes and normally it's a bit of a longer presentation. Wave everyone, we're recording and this will be going across all the social media, so make sure you ask me good questions. So we're going to do a bit of a presentation on the Certax Property Tax Specialist panel. We've sort of done this before, but we're going to focus on the Q&A for the people who haven't experienced the fun or didn't hear me last time. Hopefully they can hear me now. We're getting a bit of fun. Do you want to put the slide down? Perfect. So this is sort of the agenda, and we're going to summarise and just blast through this and try to cover all the key concepts because there is a lot of stuff in there. So what I wanted to blast through is what the offering and the key specialist services, because everyone will know, and I was speaking to some of the other franchises earlier, we're in a crazy time right now. It's called a recession. And when recessions happen, it doesn't matter which part of the industry or whichever industry that you're in, you will feel it. And therefore you have to differentiate yourself. So the key thing is when you've got property clients, and this is how you can differentiate, it's a very specialist area. Does everyone know that? Obviously being accountant and tax advisors. So you need specialist advice covering accountancy, tax, legal and financing. That's the key difference maker here, because normally people only focus on the accounting, maybe the tax, and they struggle with the rest of it and therefore don't do it. And that's what normally happens. So the key services that we're providing is basically when you've got clients who've got properties in their own names, and people will have it, they've been hit by Section 24, which people will probably know, which is a tax on interest in layman terms. You need to be thinking about incorporation potentially and making sure that we can do it in the most tax efficient way. And that's what this key part of this service will be. So we normally go, and I'm going to be paraphrasing this through, so apologies, is we go via partnership, either general or LLP. LLP is preferable because it has slightly different rules to general partnerships. And then you go to a limited company. You have to do it in a certain sequence, and you have to make sure that the circumstances are tailored to the client. In a summary perspective, normally when you're going from the LLP to the limited company or general partnership limited company, to be able to claim incorporation relief, which is obviously the protection against capital gains tax, you have to illustrate 19 hours or more, 20 hours of work in the business per week. And we've got certain metrics that we look at, so it's not just down to how many properties, it depends on what you're doing with the properties. HMOs are slightly more labour intensive, single buy-to-lets. So we look at that, we do a review, and then we set the strategy. And that's one of the key services that we do. And that's huge because if you do it properly, you don't pay CGT at zero, and you also pay stamp duty land tax at zero, which is quite advantageous. The other bit I've just mentioned there is capital account restructuring. Does anyone know what I mean by capital account restructuring? I'm hoping people with their hands up. No? Okay. So generally is when you go from a part of LLP into a limited company, what happens is you're exchanging your value of the properties into shares, less the mortgages. The problem with that is, how do you get the money out? You had all this equity in your own name, now it's in the company. When you come to getting dividends or whatever way you want to pull the money out, you're going to end up paying personal tax. The opportunity is doing a capital account restructure. I'm going to just do a quick example on this. Imagine I have £1 million portfolio, and I bought it for 500,000. It's worth 1 million now, and I've got mortgages up to 300,000. What it means is that 300 to the 500,000, I can do something smart called a capital account restructuring, is by taking debt before I incorporate. And we normally do something called an overnight bridge. What that does is the next day when the company's set up, you pay that back, you've got a £200,000 director loan account. That's what I mean by capital account restructuring. That means the first 200,000 post-tax that you make, you pull it out of the company tax-free because you've got a director loan account. Does everyone understand that concept? Yeah? So it's very important to get the structuring correct, because what you don't want to do is lose the benefits. And we evaluate that on every client basis. The other bit is family investment companies. Liz, let me know about time as well. So before we go, family investment companies are the way when you put it into a limited company, how you hold the structure to pass legacy planning, i.e. protect against future inheritance tax. So what happens on this is we set up a share structure with legal agreements. This is why we use barristers for the legal aspect, and they do it with the kids in mind. If the children are under 18, obviously they can't be shareholders. That's when you have to have a discretionary trust in part of that process. The shares are unallocated and then they can get allocated in a discretionary trust in the future once you obviously pass, you and your wife, normally it is owner-managed businesses. I know there's a lot of stuff there, but key benefits are incorporation, minimal tax, or in some cases no tax, get into a limited company, protect against inheritance tax, and also therefore you're protecting against income tax in that process. I know I'm summarising, but I wanted to blast them all out. Right, property developers is a whole different aspect, but what we do with property developers is very different to landlords. The first bit was all about landlords and property investors. Everyone knows the difference between property investors, property developers. Perfect. I'll explain it just quickly. Investors hold property for rent, therefore they're investors. Developers generally buy property to add value and sell it on. And then it's considered stock, therefore it's a property developer, it's a trading business. Total different ballgame. So we typically use SAS pensions incorporated with the strategies on there and group structures. So I've mentioned group structures at the bottom. They are very, very advantageous. And anyone, going to be a bit personal aspect, anyone watch Sky TV? Yeah, Sky Property TV, right. There's an episode on there which I've done on this. And the reason why you have group structures is because the exit changes. You can actually pay 0% tax if you do it properly in a group structure on property developers, but you need the planning to be put in place before, because developers generally go and reinvest money, so they've got different rules, because trading businesses are dealt with totally different to investment businesses. And because you're part of Certax, we get all this fun done, and you can help your client with these specialist services that we will provide, and then you get the client back. The last bit I also wanted to talk about is SDLT in a bit of detail. When you buy property, especially depending on what you're doing with it and what you're actually buying, it's got a whole different SDLT regime. The lawyers, no disrespect, we haven't got many lawyers here, so the lawyers will not cover that. They will just go on HMRC, go on the calculator and do the basic aspect. They will miss all the reliefs in that. And if you miss all the reliefs, there's no benefit to anybody. But you as accountant, tax advisors, you can put cases to us around SDLT before acquisition, emphasise, so we can make sure we're claiming the right release, and we can give the advice to the solicitors that they can then action, and therefore you guys can benefit, and also the property tax specialist panel. And there's a whole lot of reliefs depending on when you're buying multiple properties, annexes, commercial property, combination of commercial and residential. There's a whole list of them. The other thing is, with this planning, there's certain other aspects that you have to think about. VAT can be quite beneficial in limited companies as well. So we can look at the whole holistical picture of this. Next slide.
With a little bit, we've got 15 minutes left.
Right, I'm going to blast through. These are the culprits that will be on the property tax specialist panel. Jeff unfortunately couldn't make it today. He's got certain things going on, but he's actively part of this. Obviously Ishtiaq and myself. So we'll be doing this, and we've got all the details in the later on it. Do you want to go next one? It cures a few headaches, which I've just mentioned for your clients, and therefore you will keep them for a longer perspective because you're adding huge value. And as I mentioned at the beginning, in the environment that we're in, it's all about adding value and differentiating yourself. Blast through to the next one, please. Obviously, the benefit of the franchises is what I've just mentioned. Also, we do give introduction fees depending on what type of service that we're doing, so you can benefit that way as well instead of having to invoice the client. Next one. This was an example that we went through. I'm not going to go into it because we want a Q&A. Go on the next one. This is how it works, is that we basically do a strategy session with the client. First of all, we have to do a fact find. The accountant can do the fact find, or one of our team. We've got like a spreadsheet that they have to fill in, because it's so important to get the right information, as Ishaq will know in cases, because if you get the wrong information, you're giving them wrong advice, and that's not what we want to get to. And then we do a strategic consultation. What happens after that consultation is that we give them written advice around what potentially they can get and do, and then if they say yes, they want to go ahead with it, those recommendations are backed up by the barristers who've got 10 million professional indemnity cover to make sure we're up to date on everything, and therefore they can then action it. Next one. Right, wanted to get Q&A.
Right, I'm ready to run around.
Perfect. Do you want to just do one more slide down? I've just got leave it on our contact details. So we have actually got an email address. So there's the email address, so do take a picture of that. I know I blasted through quite a lot there because we've got a small amount of time, but I wanted to do Q&A, and Liz has got a device there, the lapel, which will basically record the questions that you ask, and we'll share them, and everyone else can share them as well, because this is value to the Certax franchise.
If you're happy, Zee, I'll email you all this slide deck.
Yeah, perfect. No, absolutely, absolutely. I've given one example in there. Sorry, Ash wants to kick it all off. Love it.
Getting my exercise.
Do you want to stand up, Ash, so the camera can see it? Otherwise, perfect.
I was having chat with one of the person who is actually working on a helpline somewhere in institute.
Yeah.
And he told me that HMRC is very particular now on these kind of measures, and they are targeting it, and they do not like it. And to what extent we are safe to get this kind of...
Don't worry, I'll repeat the question for everyone.
Right. So to what extent we are safeguarding ourselves for this kind of investigation or backfire from HMRC, because he was very certain that it's not workable anymore, because he works on a helpline on one of the industry like insurance and other things.
So really good question. Ashley said, how viable is this tax planning and what are the implications to HMRC? So this tax planning has been around since probably 2014-16 extensively, post something called the Elizabeth Moyes-Ramsey case, which is where the precedent was set. No disrespect, even if HMRC watching, I know they watch my stuff. This is legitimate tax planning because they have actually investigated family investment companies. They set up a unit to investigate and they've said it's legitimate. Do we know why they said it's legitimate? Because most of the politicians have got these put in. So they are legitimate models. Also before 2018, all of these used to get non-statutory clearance. That's why we know it's a legally legitimate business, provided you follow the solution and the criteria. And to back it up, there's a 10 million PI cover. And the barristers, as Mark came last time, they got a no claims bonus still there. So normally what my understanding is, we've probably done 20, 30 of these, more than that. They've done hundreds, even probably clearing 1,000. They say on arguably 1% gets investigated, and when they see the paperwork, the legal sale agreement and all the aspects, they've got no issues with it because it's legitimate tax planning. Actually, I'll go in further. HMRC want you to do this. Does everyone know why? Because when you've got properties in your own name, they don't seem to get their tax receipts properly. When it's in a limited company, they're more likely to have a legitimate business and get tax receipts, and you will be compliant with HMO rules, etc., etc. So they actually propose that you do incorporate. Even the funding aspect, there was an argument about, can you have legal and beneficial ownership? I think Francis, when we spoke previously, raised a question around this. HMRC actually changed their manuals subsequently to say you are allowed, because legal and beneficial ownerships have been in this country for about a millennium. Does everyone know what I mean by difference between legal and beneficial ownership? For the people that don't, legal ownership means that I have the property in my name, but beneficially, someone else owns it. And that's really important because you get taxed on beneficial ownership, not legal ownership. And that's very important for when you do this. Also part of this, there's a review of the financing, because you have to review the terms and conditions of the financing organisation. About 95% allow it, but there is the odd ones that don't. And if they don't, then you can't do some of this stuff unless you remortgage when you move between your name and the limited company. Sorry, does that answer your question?
Yeah.
Perfect.
What exact document?
Wait, hold on.
Sorry, what exact document actually would be ratified or would be drafted by the solicitor in this case?
It's barristers in this case, so they're tax barristers. So what they do is a legal sale agreement, and also the agreement if you have a family investment company, the structure of the company, what the shares are, and what implications they have. So they do all the legal work behind that. And that's really key, because if you get investigated, that's what's going to be looked at. Even if you don't get investigated, which is very low in this case. But the bigger thing is, God forbid something happens to you, because unfortunately we don't live forever. That's the reality of life. These are the agreements that your beneficiaries, your children typically, are going to rely on. So you need those agreements in place and exactly what happens. And also part of this, they set up your letter of wishes and your will, because that has to all be lined up with what you're doing. Because if they're not all lined up, you're not going to get the benefit. Has that answered the question?
Yes. Sorry, it makes sense.
Sorry.
Stand up.
Yeah, stand up, please. Sorry.
Yeah, it makes sense to, if you're going through this route of legal ownership, to put only if you're having more than one property. It won't work out in terms of cost, really, to put just one investment property into this.
It depends. So, really good question. Francis has stated that is it worth it if you have one property? The one property you wouldn't be able to incorporate, because under case law you wouldn't be allowed to get incorporation relief, because you have to illustrate if it's a trading business. However, if you're starting now as a investor or landlord, you would put them in a limited company to start off with. Right? The question then is, should it be a normal limited company, a standard one, or a family investment company? The question is, obviously the value of the property that you're buying and how much you're going to scale. Because if you're not going to scale, then it's not much going to affect your inheritance tax. Right? But if you're going to scale, then you want to do it early, because remember, we're protecting against future growth. Existing inheritance tax has to be tackled in a different way. And that's got a bit more harder because of our friend Jeremy. And I think John went through the capital gains tax reliefs and the annual exemptions. There's a question over there. Sorry, did that answer the question?
Yeah.
Perfect.
We've got like 5 minutes left.
Oh, we should add longer. Oh, sorry.
Yeah, my experience of barristers is that they give a legal opinion, but never a 100% legal guarantee. Is this different?
Really good question. Apologies, your name? John. John has raised a really good question. He said barristers give a legal opinion, no guarantee. That is correct. But if something's been in place and has been going and has passed HMRC clearance when you could get clearance, and it has not lost the failed investigation, then that's considered a legitimate tax planning. Otherwise, we would not be able to do anything in life, would we? Yeah, but you're absolutely right. Barristers give opinion, but this is family investment companies. As I said, HMRC had a special unit. They are legitimate planning. This incorporation, provided you do it correctly, because there's case law on this, so you don't even need the barrister opinion in that sense, because the case law determines that that's allowable or not, because HMRC, under the Elizabeth Moyes Ramsey case, have already got a case mark in place. Has that answered the question? Perfect. Really good question, by the way. Have we got time for any more? Go on. Wait for you.
Just a quick question. I've been asked many times when this model becomes viable. If I'm an accountant looking after clients who've grown up with the last 10 years to 3, 4, 5, 6 properties, when should I bring you in to think about I need property tax specialist?
Really good question Ishtiaq asks is, when does this become viable? And I've just got to adjust this question, when we bring us in, as you know, Ishtiaq, because you know what we're doing on this. So the key part is depending on the person's circumstances. Because if you've got a property portfolio, because I'm in the Midlands, a bit north, as you go further up in the country, the value of property changes. So you have to evaluate the cost of doing this with the saving it's going to do, not just now, but in the future. Because as everyone knows, properties are part of your estate, and therefore inheritance tax mitigation is quite a big one, and that is one of the biggest drivers. The other big driver is if you've got it in your own name, tax on interest, and that's become huge right now because the finance costs have risen. So now most property portfolios that are in the people's own name are not viable. Has everyone noticed that? that if you look on their tax return, if they're getting only 20% relief and they're a higher rate taxpayer, and they become a higher rate taxpayer because of property, in the nicest possible way, they're going to be in a lot of problems. And most of them will be probably selling. And that's what's happening because they don't know you can do this. The problem, I guess, is for people who've got 2 or 3 properties and they're not HMOs, they have a halfway house. And they probably need to think about a partnership, especially if typically it's been the wife, but it can be a husband now who's a lower earner. By using the partnership, you can spread the income without having to do a Form 17. And that's a huge benefit of a partnership. But that also gets your business ready for an incorporation in the future if required. Because if you keep it in a partnership generally for 3 years, you can incorporate with SDLT. And that is the fact of a thing. And that's actually in HMRC's manuals and part of SDLT Finance Act rules.
So how many property makes it worth?
Really good question. As I said, it depends on the value of the properties. Because
What's the ballpark?
so this planning,
10 million?
I would say that if you've had property, say 10, 20 years, right? Or if you had a property 10, 20 years, the value that it's gone up, even if it's up north. Imagine you had a properties, let's give an example, that you bought them for 100,000 and now they're worth $1 million. If you sold those for capital gains tax alone, you would be paying capital gains tax on, 300 grand roughly, it'd be 28% of the 900,000 uplift. So if you incorporate, what happens on incorporation, that's another huge benefit, is the market value goes on the balance sheet of £1 million. So you've washed out all the capital gains tax. And if you sold, I wouldn't expect you to sell all the properties on day one because HMRC will not be happy with that. But if you sold one of the properties on day one because it wasn't making you money after incorporation, you would pay 0 corporation tax because it would be based on the market value on incorporation. So there's a number of benefits depending on your situation. So you've got to look at the person's situation. You can only do incorporations generally 5+ properties, or HMOs you can do them less because of the 19-20 hour rule. So certain conditions you have to meet, and also is it valuable to the client.
So ideally 5 properties.
Ideally, I would say that because that would be able to justify 19-20 hours. But HMOs, you could do them probably 3 because they're more labour intensive. If you've got service accommodation, slightly different rules as well. They're quite labour intensive properties, aren't they? So it depends on the valuation, and that's part of this. We evaluate how much time, effort someone's put into it, because we've got to make sure these recommendations are backed up by the barristers, because they have to agree to them, because their PI is on the line here if it's wrong.
That is going to have to be the last one.
Yeah. So could you just explain the process to me as franchisee? Would I send an email? What do I send? What do you do? And how it happens?
Perfect question. Ishtiaq's asked about the process. How do we help the clients of our franchisees? So there's an email address there, cpts@certax.co.uk. What you do is you look at your property portfolio clients. Either they've got them in limited companies, should they have a family investment company, if they've got an inheritance tax issue, or if they've got properties in their own name, are they getting hammered on tax, as well as whether it's actually making them any money, how many properties they've got. If you've got that, what you do is you email here, we'll give you a fact find, you can fill that in the Excel spreadsheet, then we can decide whether it's worth going ahead or not. When we say yes, we're going to go ahead, that's when you have to pay, or your client has to pay the £400 fee for a consultation via Zoom or in person, depending where they are located in the country, and then we go through the solution with them, and then they can then make a decision whether to take it forward or not. Has that answered your question? Any other questions?
Or just text.
Well, you got my number. I'm hoping we don't pass that number around, because I'll get a lot of calls that way. But does everyone understand what the value is? And I think that's what. Sorry, you've got to get this, because otherwise later, my marketing person outfit, we'll probably cut this part. It'll be like, what are you doing? But we want to communicate the value. Stand up.
So if somebody's got 13+ properties and they're not incorporated and they have got 2 children, we can definitely give this advice to them.
Of course. The thing is, it'd be an eye-opener. Yeah. So I'll give you an example. We've just done one recently. We're just finalising it. And Ishtiaq can testify as one of these clients. Ishtiaq, I think saving £5 million in tax. That's not liability in tax. So everyone's eyes open. 5 million in tax. And it will be bigger. That's based on a conservative, because in UK generally, it may change going forward, but property doubles every 10 years. So what's happening is your inheritance tax is getting bigger. Yeah, so you're future-proofing this with this solution. Because what you're doing, and I'll finish on this because I know the next people are going to make a big difference, Hamlet are coming on, is that basically what you're doing is you're freezing the inheritance tax. That's what you're doing. So what goes in the discretionary trust for future growth is the shares that are the growth shares. And they separate from the husband and wife, or your mum and dad, who have actually owned them, and therefore you're protecting against inheritance tax. Does that make sense to everybody? Perfect. We'll get that. In this case, it's put mortality to barristers generally on this stuff because they've got agreement. Because it's under their client. Yeah, also another benefit is you get the client back in a limited company. Potentially you might have to do discretionary return or an LP return. Therefore, you can charge more on ongoing fees, and also you can incorporate value, and you will get on the bigger ones a commission referral fee, which could be up to £2,000.